What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. If you pay attention to the stock market, you've probably noticed a massive deluge of new companies going public via special purpose acquisition companies, or SPACs. Throughout 2020 and 2021, more than 800 companies have used this method to go public, which is more than the past 20 years combined. SPACs are a great way for companies to raise billions of dollars, while at the same time bypassing the slow and cumbersome due diligence process associated with traditional IPOs. In the early days of the SPAC mania, many of the SPACs would skyrocket as investors bought into the hype and pumped up the price. It would take a few months before reality sets in and the share price comes back down to earth. But as someone once said, if you're fooled once, you can't get fooled again. By the end of 2021, investors had collectively lost hundreds of billions of dollars on SPACs. They were understandably hesitant to throw any more money into the fire. The days of raising easy money through the blank check companies were coming to an end. But there was one company that didn't get the memo. The digital media company BuzzFeed went public by merging with a SPAC this past December. There was no honeymoon period. It immediately started free-falling on the same day it merged with a SPAC. Today, its share price is less than $5, which makes it a penny stock by some definitions. But it can't be all bad, right? Even if the stock price is now down, they should have been able to raise tons of cash which they can use to turn things around. 890 Fifth Avenue Partners, the SPAC which they merged with, raised about $300 million for the transaction. BuzzFeed was planning to use this cash to acquire rival digital media companies and achieve economies of scale. Unfortunately, because of the technicalities of SPACs, investors can pull their money out at the last minute. After the merger was announced, 94% of the investors did exactly that, leaving BuzzFeed with only $16 million. Even by SPAC standards, this was a complete disaster. They massively diluted their equity and have almost nothing to show for it. In this video, we'll look at BuzzFeed's business model and why their SPAC process was such an epic failure. Before we move on with the video, I want to thank the sponsor of our video, Public.com. Public is an investing platform that helps you be a better investor. You can buy and sell stocks, funds, and crypto, and they offer zero commissions on standard equity trades. Importantly, Public puts their members first and does not participate in payment for order flow. So unlike other brokerages, they do not sell your trades to market makers or other trading firms. My favorite part of Public is the community experience that they bring to investing. They have a social feature which allows you to share ideas about investing and finance with their community of over 1 million investors. I've found Public to be an invaluable tool when I'm looking for new investment ideas. They have tons of tools to help you discover publicly traded companies which you believe in, such as their themes page, which shows stocks related to categories like the metaverse, video games, and tons of other topics. I joined Public and you can see what trends I'm following if you search for @WallStreetMillennial in the app. Go to public.com/WSM or the link in my bio to receive a slice of stock valued between $3 and $300 when you make an account with Public and deposit. And now back to the video. BuzzFeed was founded in 2006 by Jonah Peretti. It started off as an aggregation website for viral articles. He developed an algorithm to sift through articles being shared online and find the ones that were going viral. Users could visit BuzzFeed as a one-stop shop for viral articles. After having some initial success, they started hiring their own writers to make original articles, mostly talking about pop culture and celebrities. One of their most popular features is BuzzFeed quizzes. You can take short, online quizzes which tell you things like your zodiac sign based on your fried food preferences, or tell you which Harry Potter character you would be. They also launched BuzzFeed News, where they publish original reporting. Similar to the main BuzzFeed entertainment site, it also focuses heavily on celebrities and pop culture. From the mid-2000s through the mid-2010s, BuzzFeed transformed from a niche website to a massive digital media empire. In 2016, they had 1,700 employees across 12 countries and were putting out hundreds of articles per day. They surpassed $100 million in annual revenue and received a $400 million funding round from NBC Universal. While things were looking good on the surface, running a pure digital media company is extremely difficult. BuzzFeed is free for anyone to view, and they make the majority of their money through digital display ads on their websites. The problem with digital advertising is that it's very cheap. We don't know exactly how much BuzzFeed charges advertisers, but a typical rate for display ads is $3 per thousand views, or 0.3 cents per view. With such a minuscule amount of revenue per view, they need their articles to get tens or even hundreds of thousands of views each just to break even. According to Glassdoor, the average staff writer at BuzzFeed makes about $55,000 per year. When you consider payroll taxes, healthcare benefits, and office space, it probably costs them closer to $80,000 all in. The articles on BuzzFeed aren't exactly Pulitzer Prize level, so they probably don't take that much effort to write. Let's just say hypothetically a full-time writer could write 3 articles per day. 3 articles per day translates to 750 articles per year. With an $80,000 salary, this costs BuzzFeed about $107 per article. At a $3 CPM, the average article needs to get 35,000 views just to break even. And that doesn't even consider any of the overhead costs of running their website and corporate offices. These are just back-of-the-envelope estimates, but the point is, if you have a purely ad-supported model, you need a lot of views just to break even. BuzzFeed has become extremely popular among the younger generation because of their content simplicity and ease of reading. They have over 500 million monthly active visitors across their various websites, with the majority of them being millennials and Gen Z. But satisfying this audience isn't cheap. They produce over 200 pieces of original content every single day across their websites and YouTube channel. So while they were getting an insane number of views in aggregate, when you divide it by the sheer volume of content they have to produce, the unit economics aren't that great. Despite their lack of profitability, Silicon Valley was enamored by their impressive audience growth. They raised hundreds of millions of dollars from venture capital firms, as well as NBC Universal. It's almost as if they tried to burn this money as fast as possible, hiring many hundreds of new employees and expanding to 12 countries. In 2017, just 1 year after raising $200 million, they were already running low on cash and were forced to lay off 100 workers in the US and 45 in the UK. In 2018, they laid off 100 people from their French office, and the pain was far from over. In 2019, they announced their largest layoffs yet, with 15% of their global staff told to pack up their bags for the last time. Some news desks were almost completely wiped out with just 1 or 2 employees left. In 2020, they completely shut down their local UK and Australia divisions as there was simply no path to profitability. Jonah blamed the company's failure to turn a profit on their lack of scale. The thinking was that if they could merge with other digital media companies, they would be able to gain economies of scale and recognize synergies in their advertising platform. To do an acquisition, you need either cash or equity. BuzzFeed didn't have a lot of excess cash sitting around to acquire competitors. Also, none of the major digital media companies were publicly traded, so it was very difficult to accurately assess their valuations. That made it almost impossible to agree on terms for an all-stock merger. So Jonah Peretti decided that he would have to take BuzzFeed public. In July of 2021, BuzzFeed announced plans to merge with a SPAC called 890 Fifth Avenue Partners, which would value the company at $1.5 billion. The SPAC had raised $288 million as equity to fund the deal, as well as $150 million in convertible bonds. Importantly, they would use these funds to acquire Complex Media, a digital media company that also targets millennial and Gen Z consumers. This, along with their recent acquisition of Huffington Post, should allow them to finally achieve the scale they need to reach profitability. At the time, the SPAC market was still hot. Despite their lack of profitability, BuzzFeed represented the first opportunity for public market investors to own a piece of a pure-play digital media company. When the deal was announced, the SPAC price stayed pretty much flat at $10. That means that investors thought the $1.5 billion valuation for the company was reasonable. Everything looked like it was going well. BuzzFeed was about to raise $450 million, which they could use to further expand their empire. It's important to understand how a SPAC works. Let's say a hypothetical SPAC raises $500 million from investors. They identify a target company such as BuzzFeed and merge with them, effectively giving them the $500 million. In return, the company would give the SPAC investors 50 million shares, which are worth $10 apiece. Typically, they would also give about 20% of the shares to the SPAC sponsor as a fee for organizing it. In total, they have to issue 60 million shares. So while the SPAC price is $10, the company is effectively only getting $8.33 per share that they issue, because they have to give some of them to the sponsor for free. However, right before the merger is executed, the investors have the option to redeem their shares. That means they get their $10 back and don't receive any of the shares of their combined company. Let's say half of the investors decide to redeem their shares. The amount of money goes down from $500 million to $250 million. It's still $10 per share, so the startup only has to give 25 million shares to the investors. But they still have to give 10 million shares to the sponsor. In this case, the company is only getting $7.14 per share, because a greater proportion of the shares are going to the sponsor for free. Basically, the more investors redeem their shares, the worse it is for the company. In the early days of the SPAC mania, this wasn't so much of a problem. With so much hype around SPACs, very few investors redeemed their shares because they wanted to participate in the upside after the merger was closed. The BuzzFeed merger was scheduled to close in December. By this point, the SPAC market was largely melting down. Even previously successful SPACs like Virgin Galactic were more than 70% off their recent highs. To make matters worse, in the days before the merger closed, 60 BuzzFeed News employees went on a strike to protest the low pay the company provides. The minimum pay at BuzzFeed is $50,000 per year. While that's a pretty good salary in most places, many of the employees are in New York or San Francisco, which have insanely high costs of living. Based on the SPAC valuation, founder and CEO Jonah Peretti would have a net worth in excess of $100 million, while many of his employees are barely scraping by. The combination of the overall SPAC market melting down, as well as fears around the strike, caused 94% of the investors to redeem their shares. That means that BuzzFeed only got $16 million for the transaction, instead of the originally planned $287 million. BuzzFeed's share price immediately started to nosedive after the merger was finalized, and to date, it's been more than cut in half. This example shows how disastrous SPACs can be for investors who lack the foresight to redeem their shares. When you do a traditional IPO, you have to pay fees to an investment bank, but at least you know how much money you will raise. With a SPAC, it's all at the whim of market sentiment, which can change on a dime. So what does the future hold for BuzzFeed now that they're a public company? It looks like the draconian layoffs that they enacted in 2019 are starting to bear fruit. While they still lose money in most quarters, they were able to make a $32 million profit in the fourth quarter of 2020, which is the seasonally strongest quarter. In the most recent quarter, their revenue grew by 20% compared to the prior year. And while they only raised $16 million directly from the SPAC, they successfully raised $150 million from a convertible bond offering, which they used to acquire complex networks. So while the SPAC was a disaster, the company itself looks to be headed in the right direction. Alright guys, that wraps it up for this video. What do you think about BuzzFeed? Can they make a turnaround? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.